Now here we're going to turn into the international market. And it's interesting because when you look at the key agencies, they're increasing supply forecasts going into next year. And the problem is, obviously, we have Saudi that is running well below normal. They have the extra 1 million barrels a day voluntary cut. But even if they bring that back, they're still below where they have been in previous years. Iraq is still low. You're still seeing some of these struggle points. So they do see some of that coming back in 2024. But because of the issues in demand, in terms of the write-downs in demand across the different agencies, 2023 went from having guaranteed deficits to a bit more of a balance, while 2024 is starting to get a bit more of a surplus and not a deficit, which is something that's consistent with what we've been saying, with that demand is being over-reported. That supply, you can count barrels, you're seeing it, but demand is a problem. And as the economy struggles in 23, but that struggle doesn't go away in 24, and that's where we see additional pressure points, which we're starting to see in some of these agency expectations. And this is just kind of breaking down that world demand in general, and you're getting some of those increases in the liquid supply, because again, as we like to talk about, non-OPEC liquid supply is at that 68.1 million. And that's where we are getting some of that increase, not only just from Latin America, but also from the US, not so much on the crude front from the US, but liquids, but we are getting it from the crude side from Latin America. And that's where you're starting to get some of these adjustments in terms of how much volume is there and what does that demand look like. And some of the things that we're starting to get some adjustments to is, what does demand look like? How does demand look? And OPEC still continues to, in our opinion, overestimate where demand is, especially as we go through the remainder of this year, but also into next year. So then when we start looking at shifts in flows, so here we are looking at China scooping up Iranian barrels. And when we go back over the last 10 years, you can see that China is buying more Iranian barrels. They're cheaper, anywhere between $13 to $25 off of dated Brent. And this is where we're continuing to see some of these different flows, some of these different problem points. And again, when we look at the flows, when we look at the data, China is opportunistic, and if Urals gets too expensive, they'll go to Iranian barrels. If they get too expensive, they go back to Urals. But they're starting to run out of room. But then that's when we look at, well, what are flows doing? How are things adjusting, and what are they preparing for? So then we look at China and India exports of product, which have surged from both China and India. You look at China, we're back at levels that we haven't been at since the end of 22, which, if you remember, that's when they got their third batch. They started to increase, but diesel exports are increasing, gasoline exports. So essentially refined product exports are increasing. So you have seen an increase in or elevated imports of crude into China, but now we're starting to see state-owned refiners starting to ramp up over 80% run rates. You're starting to see the teapots ramp back up. This is in anticipation of that third batch of exports, which we think is going to be elevated, allowing them to take all of this cheap crude that they have essentially been importing since the beginning of this year and turn it into a product that is selling at a premium, and that they're going to be able to close that margin. And they're already starting it, because they're starting to use up what's left of the second batch, and front running what I think they know the third batch to be, especially from the state-owned side. Now we look at Russia. Russia flows have slowed. This is important because as we've seen this drop in distillate and gasoline seaborne journeys from the refined product, we've actually seen a bit of an increase of crude. And it's just this balancing act. Net, it's still down, but it's not down to what they quoted or said it was going to be. Then when we look at Saudi exports of refined products, still at the high end, with some of this trending back up as it continues to trend a bit higher versus where it is, because you're going to try to take advantage of this very elevated distillate crack and diesel price versus trying to dump more crude in the water, because right now there's still a lot of crude in the water. We're well above where we were in 2020. We're well above where we were in 2022. And as we've been saying, it's just going to continue to go sideways at this point. Crude oil in transit has come back down, but even as it's come back down, we still have, floating storage is staying at the low ends. We're above where we were in 21. And this is where it's like, okay, well, crude oil and floating's in there's a transition. So when you go from transit, you don't get put into the floating storage category till you're been in the stationary position for 7 days or more. So sometimes there's a delay. We do expect to see a bit of an increase, but not a huge increase, because we've seen a bit of an acceleration on imports at the coast, which just means that you're going from transit directly to land, and you're skipping some of the floating. It's still going to stay elevated, but not to the same degree that we've seen. Middle East has cleared a lot of this. Saudi has been able to sell their term. Obviously, there's less on there because there's less speculating barrels. UAE has been able to clear a bit more. Iran has been priced to sell when you compare it to what other OSPs are in comparison to heavy and mid. So they've been able to flow. But this is also good for the OSPs, because this just means that Saudi was able to push through and maintain some of those higher levels, and they've been able to clear some of this glut, which realistically was the goal of that of that additional cut. They kept it for September. It's going to be interesting to see how this progresses, as we are getting a bit more production and exports slated from not only just Russia, but West Africa as well as Europe. Spreads, when we look at NAPHTHA, it's still a problem. Again, this speaks more to the gasoline issue. And we're using this as just a bit of that bellwether to show you that heavy versus light and the issues that we continue to see on the gasoline front. U.S. exports continuing to stay robust. Where they're still staying elevated with the OSPs that happen from Saudi. We're staying well bid into and moving strongly into Asia. Europe, we're continuing to move in there. Europe has more than enough barrels when you look at CPC, when you look at Libya, when you look at the US. So you're not getting the same buying that was anticipated from Nigerian barrels. So we do see some softness coming. It hasn't happened yet in pricing, but we do see some softness in Nigerian barrels, which should be supportive for the U.S., because I would expect us to pick up some of that excess as China has cleared out most of what was remaining from Angola as well as Congo. When we look at spreads in the gas oil side into Asia, still staying strong. Again, this is what they're trying to hit when you look at India, China, Saudi, Russia, trying to capture the fact that this distillate crack spread continues to be strong. And it'll push it down, but we're still very low on storage. So even if it pushes it down, it's still going to be supportive of runs. It's still going to be supportive of continuing exports. Even as you make less money, you'll still make money, especially when you look at India and China that have been buying discounted barrels in the market. When you look at Brent still is at a discount versus Dubai. That we don't see that changing in the near term unless we start to get some deeper cuts. Excuse me. So even though we've seen some flows adjust from the Middle East in terms of floating storage, this indicates that we're going to see a little bit more, or a little bit additional, more additions in floating storage in the Middle East. Asia floating storage sitting right at 2022 levels. We see that creeping a bit higher, but again, not getting back to 21 levels, just a bit above where we were in 2022, given what we see as additional flows coming from Iran, which haven't shown up yet. And here you can see crude imports based on supertankers well above where we were in 2020. There has been no give up to the downside. And at any point in time, as we saw in 2020, they can stop buying. And right now, they're not doing that because there's going to be an increase in that export quota. So it'll maintain those flows, but you're seeing some of these different problems going down. China's Shandong independent refinery utilizations, the Shandongs are sitting at 63.8% utilization rate. still below the average. But now look at China's throughput at the state refineries. They're at a 3-month high. You're seeing an increase in run rates because you're starting to get some of this expectation of export quotas being issued and the ability for China to really take that. And state-owned guys would know ahead of others because they're going to get preferential treatment. They're going to see what's coming. So the industry's largely solid performance contrasted with broader gauges in economic health, as we've been talking about with the different levels. State-owned refiners pushed past operating rates to a record 81.19% as of August 3rd. And we should see some more of that. And the problem is, it's not because demand is good internally. It's not. This is going to be meant for the exporting market, which is why we think that even as some of their imports stay flat, you're going to get a big increase in refined product exports, and that's going to hurt the crack spread. Grand scheme of things, it's still going to be strong, but that's where it's going to start to put a little bit more pressure on some of these other refiners and what run rates they maintain. And here's what we're talking about when we look at flows of demand. Chinese driving and activity continues to be lackluster. It's compared to 2022, not a good year to be compared to. And even against 21, it's only slightly better, which again was not a good year because of COVID, because of all these issues. So again, just showing the activity issues that remain. West African floating storage has come down, still seasonally adjusted, all-time high. Some of that will start to come back up. And again, not so much come back up, but just stay elevated because of the slowdown in Nigerian flows, because this drop, as we talked about last week, a lot of that is because Angola has moved, Congo has moved, Nigeria not to the same degree. And we do think that we'll get price cuts, which should help pull this down. But we're also going to get the new export program for Angola, which will be interesting to see how that sets up. U.S. crude, gasoline exports slowed, but still above the 5-year. Distillate exports slowed below the 5-year by 126,000 barrels. You know, that was where the ARB closed a bit. And so that's where you had a nice big surge of exports into Europe. That is slowed down. So we should see some of that distillate get stuck, but gasoline continues to be fairly strong. You know, should stay just above the 5-year, but we'll go through that in a bit more detail. Propane dropped 400,000 barrels, but still well above the 5-year, maintaining as total crude exports bounced. But again, 2.36 was too low, 4.59 is too high, somewhere closer to that 4 million barrel a day mark. Gasoline, again, staying elevated. It'll trend a little bit closer to the 5-year average, but still stay at the high end of the cloud just because of the market, because of the opportunities, and because of the elevated amount of gasoline in PADD 3 in relation to other areas, providing opportunity to push this into the market. Distillate fell below the 5-year average. You know, it'll bounce, but we don't think it goes back above the 5-year just because of where the ARB is right now. And it'll likely stay just below the 5-year, but we should get a bit of a bounce at this point in time. When we look at crude oil exports, again, that nice bounce back up, not too much from that point. Propane, propylene, again, it's going to stay at the high end. We're still priced to sell. There's still demand in the market. Again, coming back to the NGL story, the liquid story, which is going to continue to be supportive. Ethane, again, moving back up. There's a lot of timing delays and whatnot. So again, we're going to get this bounce back up. Now, when we look at Fujairah had a build of 322,000 barrels to 18.8. Light stocks, it was a bit mixed. So light distillates decreased 13,000 barrels. East of Suez gasoline complex held firm, supported by the U.S. RBOB Brent crack spread and some regional tightness. But when you start looking at expectations, you got some firmness from Malaysia, but there's an expectation that demand is starting to come down just a touch in India. But then you had some turnarounds or unplanned downtime in Northeast Asia, which helped kind of support that market for a bit. But we do see that unplanned downtime reversing, as well as some of those additional flows from China, which is going to keep things fairly well situated on the light distillate side. Middle distillate had a build of 224,000 barrels. East of Suez, ultra low sulfur gas oil complex was fairly steady, but it's all a matter of what is that third batch. Their expectations right now for August is for China to export 600,000 metric tons. So far, it's trending a bit higher than that. And the thing is, are they kind of gunning or front running some of those expectations? And so that's going to be an important one to look so far. And there is more gas oil supply, but demand is the same. As we've been saying, not too much one way or the other. It's going to be where is supply coming? Because demand is fairly firm. Back to the comment we made about kind of that inelasticity, but that will, again, it's going to be that supply that we do see coming, but we still have storage at 2.423 million. That's a very low end, which is why we're still going to get some of that strength in the crack spread. Heavy resid rose 111,000 barrels, stood at about 8.675. Spot trading activity for LSFO at both the Singapore and Fujairah were moderate. Again, there's just not a lot of demand on the shipping side, which is why we do see heavy. All three of them we see builds. It's just the rate of builds will be higher in heavy, disty, a little bit higher in light, especially as some of this activity, and then it'll be lower in middle, it'll go up, but not to the same rate, which is why we see gasoline cracks coming down harder than middle over the next few weeks. Brent time spreads came down a bit as we were talking about some of the softness that's come through, where it's still strong. You're still in backwardation. It's just not as extreme. And that's where it's like prices are still good, just not as good as they were, which again is pointing to some softness in the physical market. Not like and as we've been saying, that doesn't mean that Brent is going to 80. It just means that 87, 88, as we were saying, was the wrong price. We think that Brent averages that 84, 85, and it's not because demand is strong or demand is weak. It's just that supply isn't there. The benefit from what Saudi has been doing. Now you look at most Angolan cargoes have sold with less than 5 cargoes still remaining. Trading activity still remains quiet, which is again, they're still waiting for October. When you look at flows, Norway's elevated, Nigeria had some deferrals, Angola already had some deferrals. So Libya is back at about 1.2 million barrels. So there's going to be a bit more crude that can come to market, even though there is a little bit more activity on the conflict side. We'll talk a bit more about that on the Econ show. But again, you're still seeing volumes. There's still more out there, and that's why it's going to be important to see what does Angola come to market with and realistically, when does Nigeria start to decrease pricing, because they need to clear a bit more because they've already deferred into October. It's going to be difficult for them to defer anymore, and that's why we do see prices coming down. They're still going to be stronger than they were, but again, you're seeing that in Brent. You're starting to see that in some of these other grades. Europe, the only time that European storage was higher at this point in time was in 2016. Again, it's that slowdown in terms of refining activity, total refined product activity, which is continuing. When we look at the insights for ARA, gasoline had a build of 27. Gas oil had a small draw of 55. So again, the gas oil market's still going to promote some of those additional flows. Fuel oil had a small drop, but there's going to be some recracking. There's going to be some blending. And that blending is going to reduce some of their demand for that imported crude. And that's, again, going to weigh on some of those flows, because Europe is well situated based on CPC, Libya, and the U.S. And again, a lot of fuel oil sitting there. Gasoline, only time it was higher was 2020, 2022. Again, still staying in kind of no man's land, moving higher. This, at some point, will unlock into the U.S. Still, again, the ARB is a bit tough. When we look at fuel oil, only time fuel oil was higher was 2020. And this, again, comes back to some of that recracking, some of the blendings, because the ARB going west to east is closed. It's all being taken based on the Middle East, Russia. And now, as you get more capacity coming from India and China, it's going to put even more in inventory, and why they'll blend. Again, back to what we talked about with Malaysia, you had some total stockpiles come down in Singapore. We do see that reversing as that new product comes from India and China, because that's showing what's loading by the end of this week. So it still hasn't hit the data here. We do see some of that reversing. Light distillate came down a bit, still above where it was in 2021. We do see that trending back up. But when you look at it from a middle distillate side, you're at some of the lowest you've ever been. And even as you get some of that additional flow, you're so low on the product storage side that even with that additional product, you're still going to get strong crack spreads. You're still going to get some activity. And again, you're going to be in a good position if you have the ability to sell middle distillate. Now, resid, heavy disty came back down. We do see that bouncing back up just because, and this is looking back at the shipping side, imports, exports. We'll talk more about this in the Econ show, but we don't see a lot of activity on that front. North Sea trending a little bit higher on floating storage. Again, some of that pricing is coming down a bit. That'll help move some of these cargoes. And then when you look at Europe flows, floating storage has come down, but you're still priced to sell. You're still priced below where we see UAE pricing, Dubai pricing. You still have a lot of storage onshore. So again, we do see floating storage ticking up a bit, and that will, again, put some pressure in terms of where we are on the European side. So that's what we have for you, globally speaking. If you have any questions, again, we'd love to hear from you. If you want us to cover any specific topic, please let us know. And we hope you enjoy the rest of your week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.